Hi everyone, welcome. Yet another EstaSHE session. This one is December. Finally is December here, and we're going to speak about an epic topic today. Thank you all for joining in, or perhaps you're watching this later. I'm Alex. I'm the founder and CEO of Trolled Labs, and amongst ourselves, we have also wonderful speakers today. We will be speaking about tokenomics, right? What is the current status of tokens actually in today's market? Where are we going from a fundraiser perspective, maybe from an investor perspective, maybe from a compliance perspective, a utility perspective, all of that going into 2026. This is going to be a very, very interesting talk. Fundamentally, what we're going to do, first of all, I would love to say epic welcome to all our wonderful speakers. First of all, Sarina Björklund-Rein, the project manager at Blockchain Sweden, also tokenomics and tokenization strategist. Hi there.
Hi, thank you for having me.
Of course, Tony, no one else but Tony Drummond, the founder of Tokenomics.net and a Web3 advisor and coach.
Welcome. Thanks for having me. Thanks for having me. Look forward to it.
Wonderful. And last but not least, of course, also Jesse Wachtel, the founder of Decentralized Ventures and also the CTO, of course, of Trolled Labs. Jesse, welcome.
Good morning. It's good to be here.
Yes, we are across different time zones. That is absolutely epic. People from the US, people from Europe. I know that lots of people even sign up that are watching from Asia as well. So amazing that you're all here. Now, before we start with the questions, I would like to say two really quick things. First of all, we are live. So if someone is watching on a LinkedIn, feel free to comment. And we will try to also address your questions or your comments here live on screen. Alongside that, EstaSHE is a Trolled Labs female initiative to really build a group of female professionals in this space. Now, as you can notice, we do have some male speakers here, which is epic because we have wonderful male allies as well who can support, for instance, our efforts. Ultimately, we're also building Web3 together, and Web3 is merit-based. And at Trolled Labs, we're building Web3 networking and event solutions. Now, said that, may I perhaps start with you, Tony, to give a quick introduction to yourself, about yourself?
Yeah, thanks for having me, Alex. It's great to be here. So my name is Tony Drummond. I'm the founder of Tokenomics.net, and we basically help projects figure out everything related to their tokenomics, and that's what we specialize in. My background is I bring with me over 25 years in a variety of roles across traditional business, sales, marketing, finance. I've worked in as a Lean Six Sigma Master Black Belt, and I got into this space and I found a real passion around it. And I've been in this space since 2017, been consulting on tokenomics for about 3.5 years now. And I absolutely love working with founders, and that's my passion. I scaled my own project to over $200 million market cap, over 75,000 community members in the last bull run. And I learned a lot of what worked and what doesn't work. And that's really what I seek to share today is, and also with others, is not just the successes, but also painful failures, because that's what we learn from as an industry, isn't just what works, right? Experience is also what didn't work. And that's my passion. And that's why I'm also happy to be here today with you all. Thanks a lot for having me.
Wonderful. Thank you so much. Indeed, I can confirm that we're live and everything is working. Was just checking the tech. Zarina, please, would you like to go ahead? We'll be epic to hear from you too.
Yes, sure. Thank you, Alexander, for having me. Looking forward to this. So yes, I'm the project manager at Blockchain Sweden. So that means I help with blockchain adoption in Sweden and help companies understand how to use blockchain and tokenization. I have worked also with tokenomics, with early stage Web3 projects, and I've been doing that for around 2 years. Before entering, I'm also, before that, a blockchain developer by education. But before that, I actually worked with horses, equestrian. So that is a whole different world, but it's also really helped me to stay calm and structured when I approach this fast-moving tech project. Thank you.
Super, super interesting. Lovely to hear about your horse background, literally as well, indeed. Jesse, would you like to take over and maybe share about your pool background, possibly?
My pool. Yeah, I'm a bowler today with my pool background. Yeah, hey everybody, good morning. I'm Jesse. I'm the CTO of Trolled Labs. I've got a background in full stack development. Been everywhere in this industry in the Web3 world, from real world assets to deploying ERC20 tokens and writing all the smart contracts for all those things. And really kind of a big focus in the auditing side of things and ensuring that what is going on chain is what's supposed to be on chain, and there aren't going to be any surprises later on down the line.
Yes. Thank you for being so brief and concise, everyone. Much appreciated. So we have a schedule full packed today. We will be speaking about lots of different things, looking at 2026, as I said, but also at the current status of the market, including tokenomics. Now, I would love to start actually by posing maybe to all of you, what is, in your opinion, if we go straight away and think about projects, right? What you have observed across your expertise, what can be potentially labeled as the single most common tokenomics mistake that causes new projects to fail within, the first couple of months, first year, perhaps? Tony, I'm sure that you quite likely have some thoughts. Would you like to share them with us?
Yes, of course. So the one question I would ask is, who are you distributing your tokens to? That will determine whether you live or die, right? So for example, if majority I'm distributing it to people who want to sell right away and profit, then I should expect to be sold for people to take that for profit. If, however, I distribute to people who primarily would want to use it, then I should expect more utility than otherwise, right? And that's how I really see it is, in the very beginning, who are we giving those tokens to? If we talk about the first year, who's getting those and how is that being distributed? And then if you don't have adequate liquidity to support whatever you're distributing, no doubt it's going to be a negative selling pressure event, right? But if, for example, we're mindful of what we give out in the beginning and we have a reasonable schedule and we have adequate buy pressure and volume and liquidity, then we have some reasonable chance of sustaining some of that potential selling pressure, right? Maybe even overcoming it to go towards the upside. So that's the biggest thing I think about, is the perspective of who's getting those tokens.
Oops.
We lost Alex, so I'll continue and I'll advise.
I can jump in if you want to, Tony.
Serena, yeah, why don't you answer a little bit of this question as well? There she is. She's back. Okay.
Yeah.
All right, Alex, you're back in charge. Go ahead.
Hey, Serena. Love to hear
Serena
from
was
you.
answering a question.
Yes.
Go ahead.
I think you put it really well, Tony. I just wanted to add basically what you are saying, but to put it short and sweet, the most common mistake is that people design token or tokenomics before even understanding real user behavior or real demand. So basically they start with supply, etc., instead of just who needs this token, what is it for, and what is the purpose. And I think there is a win-win situation where tokenomics actually can improve the product, and there is a real need for this product and a real user base, and then it will go good. If it's not a need for the product or the token or a real user base, it will be hard. Yeah. So I mean, just to add to that, project that survives, I mean, they usually design tokenomics that is an extension of a product use, not just a standalone financial model created for fundraising. But yeah.
Yeah, and how have we seen that often, haven't we? I cannot even mention the amount of investors that even said to us during our prior fundraising efforts, yeah, just launch a token, right? Way easier, some VCs said, even venture capital firms. No, we haven't done that, but I can imagine that from time to time, it's very, very tricky to maybe resist that temptation. Now, let's move to Jesse. Do you feel that you have something to add here, or are you good to go?
Yeah, well, I was just gonna say, like, from the developer perspective, there's that, making sure you've got the rules proper in your smart contract, and kind of have that long view of really being able to project out your growth in your token, what your business is going to be doing, the right fit there, but also your proper lockdown timings and things like that. If you're distributing tokens and you don't want people to be cashing them out as soon as they're on the market, you need to put the rules in the smart contract and ensure those things happen. And one thing that we see happen a lot of times in this industry is kind of like agreements between companies where we'll give tokens for these services, and I promise I'm not going to cash them out, but if it's not locked into the smart contract, then they're going to get cashed out.
Yep. I want to tack on one other thing for Jesse, because you brought up a great point, is what you want to think about as a founder is, what's the blockchain say? Have you labeled the wallets? And those, for example, do we have a team finance vesting contract that's also labeled, where we know exactly, like what Jesse's mentioning, exactly what's there? That's important from that perspective too, is that communicates on chain what tokens are held where, who holds those, and how that schedule works. You can't oftentimes come back and see the exact wallets because they obscure that. They do that for reasons of that, right? But anyway, you can then see how much is locked up, and you can also see how long it's locked up as well, which, as Jesse mentioned, is really important. I want to highlight, though, you want to make sure you're labeling and you have all that transparency on chain. You're communicating that, really important.
Absolutely. Thank you for having added that, everyone. It's so interesting to hear all your perspectives here. I'm just really quickly, actually also moving back to Zarina, because I do have also a separate question for you yourself. Maybe the others want to add something as well. That is really looking towards 2026, right? If we're looking at the token launch models, like I think you recently mentioned something about a comeback of kind of like ICO styled launches. Would you care to elaborate on that perhaps a little bit?
Yes, thank you. Yes, for sure. I think we see a big shift from having these highly VC-dominated launches with high FTV and low circulating supply. I mean, since we all know that these models can have poor outcomes for retail participants. And what we're seeing now is a comeback of ICO-style community-first launches, for sure. And I think it reflects better alignment and fairer distribution. And also we want it shows earlier community involvement. But however, compared to the ICO launches we had before in 2017, where it was the Wild West, I think the difference now when we have them back is that they will be more structured and more compliance aware and transparent. So basically have more staggered launches, uses-based distribution, and more clear communication around risks and unlocks, for sure.
Fantastic. Something tells me, Tony, that probably you have something to add here.
Yeah, I mean, the biggest thing that I pay attention with a lot of the VC unlocks and everything is we have to realize that venture capital has to make a profit as well, right? So if you're going to raise through venture capital, then you have to keep all this stuff in mind. But I do find that decision specifically to be a big kiss of death in a lot of cases when it comes to who you're giving those tokens to, how you're fundraising. And a lot of projects will kind of lean into what they're being instructed with from VCs as well and kind of follow that lead. And it does have some negative consequences. And we've seen like Monad be a great example of this as a recent example of these kind of high FTV, low float launches, right? And the reason why these are so bad is if you have a low float, what does that communicate is you have a lot of inflation, right? Because if you don't have a lot of tokens out in the beginning and we have a 4-year vesting, then we expect to have a lot more later. The time period between those two is when all tokens will be released, and that means you have a lot of inflation and an aggressive amount of inflation, right? So low float to me communicates aggressive inflation. Now, in a lot of cases, they might say, well, it's not low float because we have this big ecosystem unlocked floating around. Well, that's what they use to dump on you in a lot of cases as well. So a lot of these ecosystem allocations are really used for what we'll call market making activity, which could also be loan option models to be sold down, right? We'll talk about that later, maybe, right? But there's a lot of these things I think about with this. And so you want to be really careful on how you're giving those tokens and allocating it in those investments. And that is what I've seen be a big kiss of death for a lot of projects. I hope instead we see more investment in real business activity. For example, do I own equity in a revenue generating business, like Zarina was saying, with a token attached to it, and I have then some liquidity, right? And if the token does well with the business and it performs well, then maybe I can cash out and have a liquid cash out. But I'm not like trying to sell everything into the token, because that is a PvP environment of the investors against the core users right in the beginning. And that's a no-win situation. That's what we keep seeing. Right? The very time users acquire the token on the centralized exchange to use it, everyone's dumping on them and selling them into the ground. Think about that scenario as a customer of a new platform. That is terrible user experience. Right?
Very true. No, that is absolutely true. Now, I mean, we're speaking a lot now about token launches, like maybe from a project or investment perspective. Maybe Jesse, you have a technical security background. Obviously, you're a CTO. I won't make it a secret here that we are also very much looking into launching a token ourselves, but it needs to be sustainable. We'll quite likely do it internally first, build up demand, generate revenue as a business, and then actually also use the token, to reward early stage users, our partners and whatnot, making sure that there's actual utility for the range of things that we're doing across our ecosystem. Now, not about that, because this is not about us. But Jesse, I would love to hear maybe your thoughts on, the process for launching a token. What type of decisions you find important, or do you prioritize maybe from a tech or from a security perspective? Feel free to take it away.
Yeah. So, I mean, obviously it starts with speaking with the stakeholder and also any kind of consultants that they have on as far as tokenomics are concerned, and figuring out what the utility is, figuring out, what the, long plan is, where they want to be 5 years from now, where they want to be 10 years from now even. And then kind of my job there is guiding them through the process of understanding how to turn that into code. really, and kind of guide them through some edge cases too, because we've learned over the years that the market can do some really funny things and some really unexpected things at times, and kind of your smart contract can be put through the ringer a little bit. And so, really going through the testing process really thoroughly, and getting creative and going through historical data to test anything possible, and see where you can break it, see where you can test the limits of it. And like I was saying before, also just really making sure that you lock down some of your timing events to make sure you don't have that massive inflation and things like that, and just liquefying your token all of a sudden once all the locked tokens become released. Being really smart about that, and kind of really looking forward and ensuring that no surprises are going to happen.
Very true. I wonder if anyone is, by the way, and thank you, Jesse, Tony, Zarina, for sharing with us all your expertise and knowledge. I hope no one is getting nauseous of the amount of swiping and swapping that I'm doing, right? I'm always checking like the features of other projects and platforms, and this is really nice. So if anyone is getting nauseous, just DM us. We won't move the things anymore. Now, what do we love to do now, Tony? I would love to ask your opinion briefly, and of course the others are also very welcome, to share maybe some ideas or your thoughts about market makers, right? Ultimately, they're also very important for token launches, of course, also for later on, creating liquidity and whatnot, or making sure that there is actually a market and whatnot. Now, what I want to say is that we actually just launched a couple of days ago a very interesting article. It's this one over here about market makers, how they work, and unknown unknowns. And just because so many people really in this industry don't really know really much what market makers are doing. Here, I have to say also a really important point is that one of our partners is Masternode One, which is a Dutch, wonderful, ethical, and great market maker. And they're actually powering the EstaSHE community in Q1. So I quickly want to say massive thanks to Masternode One also for that. Now, said that, Tony, please share your thoughts about market makers.
Yeah, so first of all, why do you need a market maker? Well, it's really to enable trades within the token, right? Whether that's on a decentralized exchange or a centralized exchange. As an example, some project will say, we want all this big buying volume, everything else. Well, if you don't have market making activity with proper depth, whether in the centralized or the decentralized exchange, you cannot take in good volume. I'll give you an example. I've seen some tokens out there with literally $50,000 inside the liquidity pool at a $25 million fully diluted valuation. Let's say a whale does come by and wants to buy $25,000 worth. How do you put 25K into a 50K liquidity pool without getting killed in slippage and creating a massive green candle? You can't, right? So you need the guidance of market makers, so that way you're getting awareness around your token, your slippage, and that way you can make sure you're enabling these proper trades. Whether that's happening on the centralized exchange or the decentralized exchange will determine how you give them tokens and how you manage that. Now, some of the things that I've seen that have been good have been what I've explained is the guidance from market makers who know what they're doing with ethical, transparent dashboards that can show you exactly what's happening with your tokens and with your funds and money. Like I mentioned, you will have money to distribute USDT, USDC. That's typically what they will take. Now, let's talk about the downside. Let's say a market maker comes to you and says, we want a loan option model, and you know what? We will only take tokens. Well, what are they communicating to you is in this model, a market maker might get, let's say, 1 million tokens for a month is the terms, right? So they got 1 million tokens they have to give back after a month. They're not taking any USDC. So now they're inclined to basically sell that chart down to buy back the tokens later on cheaper towards the end of the month and give you back the 1 million and keep the difference. So if you look at some of the downsides of what can happen with market making, it's really making sure that you understand the deals that you're getting proposed and you're getting the proper guidance and you're understanding liquidity and how this works, right? So if, for example, you're not providing any USDT, well, then how are you managing both sides of this books? You can't. You just got tokens, right? So you're not doing that. And so now, you're not understanding liquidity. I would say as a founder, that's one of the most important things you can understand is liquidity. And once you understand that, then you understand what you're doing when distributing your tokens and value and not just giving it into hands blindly, right? That's what I would say is the most important. And that is how I've seen the downside of market making has been a lot of the loan option models. That you will see more prevalent and larger fully diluted valuations because you have more dollar value to that you would have to pair with that. It's a lot harder, right? That would be millions and millions and millions of dollars. So in those scenarios, you'll typically see loan option models like with Monad and what Coinbase in its disclosures regarding Monad and the market makers and their terms in that case were done that way. All right. So want to provide a little bit of depth because this is such an important thing that a lot of people get wrong and they get destroyed by it. So it's really important. All right.
Absolutely. Yes. Gosh, I hope that many of our team members are taking notes. Everyone who's watching from the Skill team, take notes or watch back later. Thank you, Tony. Much appreciated. Zarina, if you feel like you want to add something, or Jesse, feel free to. If not, we'll move on to the next question.
I can add you really shortly. I think you said it really well, Tony. And I think one important thing for project is really to evaluate how we want our project to progress and what kind of market maker we should opt for. Should we have a retainer based or should we have a loan based? Because depending on what kind of market maker you go for, they have different incentives and drives to work. And they will work in different ways for you. So that is really important that you choose a model that works for your project. And also, as Tony said, they can give you really good advice if you choose a good one. But you have to understand, if it's not a retainer-based market maker, what they mostly make money from is the spread. So that means the difference between buying and selling. So if they are a bit not so serious, that of course could incentivize them to pump up the volume to make more money. So you have to do good due diligence and choose a serious market maker for sure. Then they can help you. Thank you.
That makes absolute sense. Thank you. I totally agree. I'm coming across a lot of people who do market making or say that they do market making, even at events. And I quite often get, don't get me wrong here, but from time to time I kind of like the chills from them. I kind of like feel that something is not all right. That's why it's so important to kind of like make sure that you know this, also the persons behind the company, right? And that their models are transparent and whatnot. And to that extent, I can only say that Masternode One, our kind partner, and of course the company that supports EstaSHE, they care about the world and about female empowerment too. So super happy, and I know we know these people also very well. So thank you once again. Now, I would love to maybe also check back in with Jesse. Jesse, if you're still awake. Yes, you are, right? It's morning over there, but you are awake. Wonderful. I would love to perhaps ask you, like as a CTO and someone who has been designing smart contracts and whatnot, kind of like what red flags do you check in a token? Specifically, once it's hitting the market, maybe. Any thoughts? I think you're muted. Let me just try to unmute you.
It's a little loud around here, so I had to mute myself. But yeah, I think there's a few things that I really like to look for. One, there's a lot of projects that have, over the last few years, decided to launch their token on an upgradable smart contract. And I think that, personally, that is a giant red flag because, honestly, if it's an upgradable smart contract, what that means is that the logic is always there forever, but the rules can change. And so if you're dealing with a smart contract where the rules can change, then in my opinion, it's not really a smart contract because it's not immutable. At that point, you could just go in there at any time and change anything you want to suit your needs at that time. And it doesn't necessarily suit the needs of your token holders. So that's one big thing there. Another one is, vetting the team. Who are you? Whose token are you even buying in the first place? How's their operational security? How is their planning? Is their project even, going to be good, or is this just a hype token? Things like that. And then, just also looking at things like the team token. Like how many tokens does the team have? How many tokens does the VC have? How many tokens are being held off on the side for paying vendors or partners or things like that? What do the tokenomics really look like there, and does it actually make sense? You put all those things together and really look into a project from that perspective, and you could either see the red flags or the green flags pretty easily.
Fantastic. Much appreciate that. I am sure that the other speakers will quite likely want to add something, but I want to circle back for 1 second, and that is because we have an audience question, which always prevails, of course. So Amit is asking, how can a project objectively measure whether a market maker is adding real liquidity versus just creating that artificial volume? out of nowhere, this question, any thoughts from our wonderful speakers?
Yeah, I can answer that if you like. So I would say, like, if you're looking on chain in your decentralized exchange, you can see if they've added liquidity there. Like, you could see all this stuff transparently on chain, which is great, right? So you could see, for example, liquidity and how it's moving throughout the system. And as Alex noted with the sponsor, they have a transparent dashboard. And that's ultimately what you want, is now you have the dashboard of what you're seeing, but you don't know if you can trust that, right? And so now that's why you have the on-chain components as well, you can see there. On the centralized exchange side, how can you see? Well, you want to see, on example, CoinMarketCap will show you your liquidity depth. So if you see your 2% depth is very low and you can't, like, for example, if you've given a lot of liquidity and you see you can't even take in a trade above $100, you know it's not actively being used, probably in most cases, right? Now, how you actively measure that on a centralized exchange, that's something that I can't answer because that's piped into their systems and how they manage that through their APIs. On the DEX you can, on chain you can, but in those scenarios, that's where you would look and see how the slippage is working in the swaps, right? Because if I have a very, low amount of the depth, then I would see a lot of high slippage. I cannot take in good trades, right? So that's what I would look at, is how that trade size looks with that depth. That's how I would kind of measure that. If that makes sense.
Fantastic. That is really, really tangible. Sorry,
just shortly, that was a really good answer. I just wanted to add that many market makers also sends report constantly to their project and team members they are working with. So if we employ a market maker, they usually send us report all the time, and then you can check the numbers. And so if they are serious, they will for sure, it will show that they are doing good things instead of just trying to pump the volume.
Wow, that's actually a really, really nice point. Thank you also from the audience for your engagement and for dropping some questions. Much appreciated. Now, I want to move a little bit, if that is possible, from market making, launching tokens, towards then the process afterwards. Later, we'll also look a little bit more at vesting, at utility tokens, Ponzi schemes, AI. We still have half an hour to go, and I love how, concise you all are, but still have answers packed full of usable words rather than empty ones. So much appreciate that. Now, I want to look for a second at best strategies that really projects can potentially deploy or use to really counteract selling pressure. Because of course we see that, right? Token hits the market, others, get out and whatnot. We already touched upon it a little bit, but maybe some more like other hacks or strategies. This time, maybe Zarina, could I start with you?
Yes, sure. I think one strategy that is always important is expectation management. I mean, if unlocks are clearly communicated early and it aligns with project milestones, then the market can price them in. Also, of course, when the project have unlocks that are released over time, they avoid overlapping large releases. And one really good thing could actually also have conditional unlocks or vesting, meaning that with continued contribution that will get unlocked, and that's a really great thing. Also, of course, you can introduce more real utility around unlocks to help this organic demand grow to balance the sell pressure. And I think usually also what fails is when we are trying to hide unlocks or just do it in a shady way. So I think it's important to be very transparent and keep the trust with the community.
Fantastic. Thank you. Jesse, you're already popping up, but I would love to go first to Tony. Tony, you're back. What would you add here, perhaps?
Yeah, so one thing I wanted to mention with Jesse, I want to hit on this point, is the proxy smart contract. Really important. If you have a transparent upgradable proxy contract and you lock your liquidity when paired with that, now you're done for who knows how long. Really important consideration as well. But now going into this designing against selling pressure, here's what I believe. Let's think about why someone might sell in the first place. Because of a lack of confidence in what's being created, right? Like, so for example, we have Cardano. I don't want to call out a lot of names. Let's use them as an example. There's not a whole lot of traction activity there. Why is the token doing as well as it is from a valuation standpoint, and what's actually being delivered is because of the confidence of the people that are there. So the number one way I've seen to design against selling pressure is to increase the confidence level in the people holding this of what you're doing. right? And how can you do that? Through getting revenues, through getting users, through actually driving real utility, right? So that's how. So if we think about the North Star for everybody of what can help avoid selling pressure outside of the obvious, this is what you can do, right? So how often are you, for example, if every week I'm announcing another major partnership, I should expect less selling pressure no matter what. You know what I mean? I should expect it, right? So the way I enable to overcome selling pressure that might exist no matter what is to have a reason for people to buy to enable liquidity and volume, right? How I design around that, though, is all linked directly to when I need tokens, right? And how I want to release those. And so that's the other piece of this, too. And if I'm releasing those too fast, and I can't create enough buying pressure to overcome that through either utility or speculation, which is most of the volume now, I'm going to go down, right? So how I really think about that are those two relationships. How fast am I releasing these, into whom? If it's people who might sell, that's one consideration. But the other side of it is, how am I actually driving the demand of what I'm building? And if you look at a lot of projects, they have no revenues. There's no reason to hold the token. So that's why people are selling, is literally there's zero use for it. There's no reason to hold this. That's why they're selling. Right? It's not because it unlocked. It's because the people that got that don't believe it works, right? Don't want to hold it anymore, right? That's what we're talking about. So I really think this psychology of how people think should be emphasized, no matter if you think about math or otherwise. That's what's happening, right? Like a VC, why would they sell their tokens? Because they're worried it will not go up, and a lot of projects have crashed it. So if they get their tokens right now, they want to sell now, so they're not worrying about holding it, losing value. That's why they're selling, right? So we want to think about, why is that person selling? That's really important. And what can we do to increase confidence so they might not want to sell, right? That's what we could do.
Yeah, that's absolutely valid. Now, Jesse, I know, and thank you, Tony, thank you, Zarina, for bringing all of this to the table. I know, Jesse, that it's sometimes a little bit tricky to be the third one to add their perspective, if so much already has been said. Do you feel like perhaps adding something as well here?
I agree with both of them. Just proper planning, making sure you've got the right kind of locks in your smart contract, but also, like Tony said, making sure you're a team that's worth believing in. Also, I mean that beyond almost anything else in this market, to be a reliable team is probably the most important thing in my opinion.
Well, I know one really, really reliable team that is currently fundraising, by the way. So if anyone wants to reach out to us, let us know.
Throw Labs, invest now. I just have to throw in the call to action.
All right, guys. So let's move on. Let's move a little bit from token unlocks, investments, and whatnot. We already discussed a little bit, if tokenomics can change after projects launch. Now, what I would actually really love to do is ask Tony and Zarina maybe a little bit further your opinion about staking. Just because this is a topic not everyone is super confident or knowledgeable about, including myself, I would add here. So when a project very much relies on staking rewards, in your opinion, at what point do these rewards really become almost like an unsustainable Ponzi scheme that will eventually crash the token? Now, this is a very Dutch and direct question. Maybe I'll move first once again to Zarina. Female ladies first. So
sure. Okay, just to start, I mean, staking is healthy when rewards are paid for real contribution to an ecosystem or a protocol network, but it becomes unhealthy when rewards are mainly paid by creating more token, because then you have this inflationable loop, staking to get more tokens. But with healthy staking, what I mean by that is that people are actually contributing something to the network. For instance, you have Ethereum. Proof of stake. They are helping securing the network. So they are providing a real service. They can committing to capital, but in a long-term support and sustainable way. If you have a gaming ecosystem, you have a utility token. If gamers stake, then they can get in-game items instead of tokens. So you have to be careful not just giving out too much tokens, because if staking rewards get too high and are not supported by real activity or by revenue, and by revenue, I mean that you're actually putting a part of the revenue into liquidity. Then the system really has to create more tokens to pay the rewards. And then it just increases the supply and inflation. The loop is going, the token becomes worth less. And over time, people, of course, lose trust in this token and the project. So it's you have to be careful when you plan staking.
Fantastic. Word of caution. That is great. Thank you for your transparency. if anyone is hearing noise on my side, our neighbors are reconstructing. So we're not the only builders in this group. There are builders everywhere. It seems, Tony, I would love to move to you. What do you have to add here? I know that you probably also know a thing or two about staking and whatnot.
Yeah, when it comes to staking, here's one thing I find is just empty staking. If you're just locking tokens to emit tokens so people do not sell, I think that speaks to a flaw, again, in the psychology, right? So for example, I'm holding Chainlink now, but I literally cannot stake it, right? Because it's maxed out in the staking. So I am holding Chainlink because I believe in Chainlink, because I believe in oracles, especially with everything coming on chain, that Chainlink will have a lot more demand, and it has a limited supply of 1 billion. So I'm okay with not staking my tokens, right? And I found that a lot of projects will use staking from a mindset of if they don't have a way to lock, then they will sell. Well, I think they will sell again because they do not believe in what's being built, not because they have nowhere to lock it, right? If we think about this. So when I think about staking, let's think about an example of one. So what if I have a token, and let's say I have a liquidity pool, and I want to grow my liquidity. This is literally a problem I'm working on right now. I'll explain. I have a liquidity pool I want to grow with value. And I have a token where holders can use that. And if they lock more tokens, then they can provide more liquidity and get more rewards, right? So if we think about this, if you provide more liquidity, you can lock more tokens, you can get more emissions. Now I've drawn the exact thing I want, which is liquidity depth, versus just saying anyone can lock tokens and anyone can get tokens. Here I've drawn the exact thing I want through a demand. That's what I've pulled through, right? So the token now actually has a utility, which is capturing fees and emissions as a liquidity provider. That's the goal of the token, right? And so if, for example, you're just locking a little bit of liquidity, you can't stake as many tokens as you want, because again, that would not be beneficial, nor would it help grow liquidity, which is exactly what we might want to grow in our system, right? So in that example, we're using the token to incentivize exactly what we want through the staking. And this is what I think about when I think about giving tokens out in that perspective, is what value is it actually creating, as Serena said. And that can be done in a variety of contexts, but I wanted to use it in the context of this example outside of like a blockchain network example to give a little more clarity in how you might use that, right? And then what do I have to do? I have to make sure if I'm emitting tokens, how much might that be from a selling pressure standpoint, and can I overcome that? As a simple example, one project I know had a $60 million fully diluted valuation, and then I looked at their liquidity pool. 3 weeks later, they had a $50 million valuation, and their liquidity pool had only lost $20,000 in value, yet the value had decreased $10 million in market cap. Think about this. So if a little bit of selling pressure for staking, less than 20,000 sucked out of the pool was removed. Doesn't take a whole lot of rewards to do that, and it lowered the market cap by $10 million. That's what you're doing technically when you have staking and you have this liquidity. That's actually functionally how that works. And that's why empty staking can erode the value of all the tokens through that selling pressure, right? Unless you have buying pressure to overcome it through liquidity injection of some kind.
Fantastic. Thank you. Thank you so much. I love how you guys, just answer everything so straightforward, to the point. Honestly, I want to invite you to every event that we're doing. I think for the rest of 2026, we will just only do tokenomics or whatever is your expertise type of events. Much appreciated. Now, I am going to give you a little bit of time to actually think about an audience question. How am I going to do this? Because it's a long question and it also concerns a slightly different topic. But I know that we have people here in the room who know a lot about blockchain, about tech, AI. So I'm going to put this question for a second on screen, and I'm still going to do like this so that you can still see me. So Abhishek is asking basically about your opinion with regards to AI, Web3 in 2026, your thought process about tokenization of data. Now, what I'm going to do is I'm going to leave that sit with you for a second. So once again, AI, tokenization of data, Web3, how is this all coming together in 2026? Unless someone already feels like I already want to express my opinion, but I know this might be a slightly different type of topic. Feel free to speak up if so. If not, we're already moving to the next question. Tony.
Yeah, I'll answer it. Yeah, I would say what you want to read is a really good paper by Ribbit Capital, and it talks about token factories. Okay, so look into that paper. It was released internally in June, but then I think maybe a couple months ago they released it. And they're talking about how everything will basically be a token. Like if you think about how you might exchange data or information in the future, everything will be tokenized and everything will have a token factory creating and distributing these tokens, right? Some of them might be worth money. Some of them might be a piece of information, right? So like, for example, you hear about tokens and all this AI might be a similar respect, but also when I think about the context of even supply chain, like for example, one of my clients used to be in cannabis. So how do you track from seed to sale the entire supply chain on the blockchain through tokens, moving throughout the whole supply chain and system? You can do that if you have integrations to the blockchain. You can see all that transparently. And even from a manufacturing process, you could even take that one token and divide it into even more. And where do those divide into if that plant were split into multiple different aspects of supply chain, right? So when I look at tokens and data and information, I believe we will see tokens flowing around, and those will connect to real assets, and that will be on the blockchain, and we will see transactions happening tracking those assets, and all that will be reviewable on chain. As another example, you even look at, like, for example, you have a truck that has to be below a certain temperature threshold to transport, let's say, a liquid coating, where if, for example, it goes below 32 degrees Fahrenheit or 0 Celsius, it freezes and the material's no good. How do you know through the supply chain that that didn't happen? Well, if you have a device inside of that truck and you've actually validated that device is accurate, then you know the exact temperature that that material was transporting. So when it arrives, you know it wasn't faulty. What might happen otherwise is people offload it from the dock. They don't know otherwise. They run the material. It ruins everything they put that coating on. Then you have a multi-million-dollar claim. And meanwhile, you never knew it was a trucker to begin with. They think it's the coating supplier. See what I mean? But the coating was good. This is happening right now. And that's an example of what I wanted to emphasize.
Fantastic. Thank you. I quickly dropped some links in the chat. Hopefully people have seen it. We're watching. Zarina, do you happen to have anything that you would feel to add, or shall we move to the next question?
I think it was very well said by Tony.
Fantastic. Thank you, Tony, for sharing your thoughts. I want to move for a second to Jesse, because not with regards to this question, just with regards to AI. Jesse, you have a super strong tech background. Of course, AI, general purpose technology, is kind of like all over the place. Now, I want to hop for a second and looking at the next year, good intents, like how are we looking at tokens? What types of tools can we potentially use either as founders or as investors or whatever type of, maybe you're a researcher interested in tokens. Do you have any tips for tools that can be good for us to check if, or other types of strategies maybe? This is a very long question, sorry. It's the end of the day, I've worked all day. I should probably just rephrase it. Any tools that can be good, AI or not, to actually check if tokenomics are good, feel free to share your thoughts. Thank you. And you're still muted, sorry, that was my mistake. Please go ahead.
Yeah, I would say that for the majority of people, a good place to start would be on the explorers for whatever network you're working with, and go straight to that smart contract address. You mentioned AI. If most people can't read the code, and I understand that, and so one thing that most of the explorers do these days is they make the full original smart contract code available, and they also make the bytecode available. So you're able to take those and, if you don't know what you're looking at, pop them in the AI, and I'll be the first to say that AI is not always perfect when it comes to auditing a smart contract. So you still need to be very, very careful when you're doing that. But, take it in there, drop it in, see what the results are. A lot of times, if there are any red flags, it'll tell you that there are red flags pretty quick. So that would be, probably my first and easiest step for the majority of people, because, most people don't know how to read a smart contract. So AI is definitely your best buddy in that situation.
Mm-hmm. That's definitely interesting. Thank you for that. I want to maybe double check with the other two speakers as well, if they have any thoughts on tools or maybe, strategies that you use yourselves. Doesn't even have to be something tech related. I will quickly move to Zarina first, if this doesn't catch you off guard.
No worries, for sure. I mean, usually when I look at different projects, I always read their white paper. I try to look at their technical documentation. But the tricky part is when you try to look at tokenomics, you have to read a lot between the lines, because projects aren't saying everything. I mean, I think they are becoming better and better, but mostly you have to read between the lines. But one good thing you can always do is you can go to the smart contract if the token is minted. You can always see how many tokens the project is holding, etc. So that is not AI, but it is manually labored. Usually I use CNIT token spice when I do simulations. I would love to create a really good Python simulation tool myself. I haven't done that yet, but also for sure AI is interesting to see if they can help. I mean, AI can always help you summarize text, but sometimes they get it wrong. So the best part is to read it yourself.
Fantastic. And I see, thank you so much, Zarina, much appreciated. I saw a comment actually coming in here through the platform that says, so happy to learn about tools. I was quickly checking who that was. I thought that must be Kara Howard, one ex-speaker of one of our other events, wonderful builder of a massive female community actually out there, runs an incubator, massive builder. So thank you, Kara, for tuning in. Sorry that we don't see your name for some reason. Tony, I wanted to double check in with you. Do you have any tips that have not been mentioned by any chance?
Yeah. So first of all, first tool is knowledge. So like I mentioned, when I was a founder, I knew nothing about this stuff. I just saw my chart moving around and I'm like, what the hell's going on here? And then when I started learning more about it, and I learned about tokenomics and I saw selling pressure how to change the economy. So I would change. And that was literally while I had a community of 75,000 token holders, I had to change the economy while that was live, right? So what I would say is knowledge is the most important thing to equip yourself with. But what tools can you apply? Well, you might have a deterministic model where you build out an actual revenue model. So did you build a revenue model to see this company you're building, this platform, whatever it is, this product, does it make money and how does the token connect with that? That's the first thing that you should use from a tool standpoint is to build a model through a spreadsheet to check that. Now, how might you also look at simulating that as an example? That's where I use a lot of on-chain data. As an example, with a recent client, we pulled data from Huma, which we're pulling their liquidity vault. We're looking at user behavior. We're pulling that data. We're normalizing that data. And now we're able to use that in a simulation environment. Like Zarina was mentioning, we're literally using that in a Python simulation where now we can add some noise. We can add some variation. And now I can see a whole bunch of different distributions of this data. And now I could be able to check how this might perform. You could also see how these things might perform against each other with such a situation. So the good thing about a Python simulation, like what we use in a lot of cases here, is not only do you get the data out, which you could visualize through the charts, but you could see how things collaborate and clash against themselves. And this is called Monte Carlo analysis. Typically here we could see how these collaborate against themselves through multiple different variables. Like this one might vary and this variable might vary. How do those two interact with each other? That's what we might want to measure and see the outcome. So when she mentioned what tools we use, that's what you would apply is your revenue model, deterministic, and then seeing how that might perform through research and real data and real user behavior applied with the simulations, right? And that's what we use.
Wow. Gee, Tony, no wonder that you have all these courses out there and like, yeah, but an entire platform, right, with tokenomics.net. Is that also the best way that people can reach you, or do you prefer like through LinkedIn?
Yeah, LinkedIn. So when I started Tokenomics, that I rebranded to Tokenomics.net, and I have a free course and template, but I'm putting a lot more time into a brand new course, brand new template that's going to be phenomenal. Okay, it's all going to be free. Yeah. Everything is free, by the way. So if people want that, go to the tokenomics.net. You can grab the free course right there, and that's why I do that. But I did not put as much time into the demand side on the token, right? A lot of people were focusing on supply side spreadsheets in this side. But I want, in this course, I'm going to build out a full data room with everything you need for your token will be there through an example project. And that will be something that we'll give out as an example for people through the course. So now they can see an example of greatness and apply that through the course material. That's what we're going to do. Okay. So, all right. So that'll be out, working really hard on that, but that I'm hoping to have out early January, late January of next year, right? That's my target for that to be out there. So, yeah.
Fantastic. Fantastic. Now, maybe Zarina, I haven't asked you this before, but like maybe there's something that you feel like sharing with the audience in terms of what you're doing or how they can best reach you, just to give you an opportunity, right? So many people are watching this later, just as a side note.
Thank you, Alexandra. Thank you for sure. Please use LinkedIn. That's a great way to connect with me and write to me if you have any questions. Just open LinkedIn and send me a message. That would be great. Thank you.
Fantastic. Thank you very much. Jesse and myself can, of course, also be reached through LinkedIn or through the Thrilled app or wherever you feel like, finding us. We're everywhere. Happy to talk 24/7. Let me just put this away. You would think that it's easy to talk and to do all of this at the same time, but it isn't, even though I'm a woman, so I'm supposed to be very good at multitasking. I'm not sure if it's the right moment to talk about stereotypes, but most definitely it's the right moment to continue talking a little bit more about 2026. Now we still have some minutes left, luckily, and we have another question lined up for you. Actually, I would love to start with you, Zarina, because if we look towards the next year, of course, we've spoken about token, like how is it being launched, you know, how we keep it on the market and whatnot. But a big important part is, of course, also compliance and regulation. Like, how do you see that influence tokenomics? Very broad question towards 2026. Anything that you feel like sharing, any observations? Would love to hear from you.
Yes, sure. I think that's a really important part of tokenomics that some projects maybe not pay so much attention to, but I mean, regulation is always influencing tokenomics, whether the project acknowledges it or not. So I think going into 2026, token design that ignores compliance will actually struggle to work with companies, institutions, and public funding. I mean, if you in Europe, if you go to any SEX, they will as soon as you want to launch a token, they will ask, is your white paper compliant with MiCA? So you have to really pay attention with regulation from now on. And I think that will definitely make us see clearer utility definitions or clearer use cases, slower emissions, and also, of course, fewer financial promises, because you cannot legally promise something that you don't hold up later. And I mean, sometimes regulation can be a hinder for innovation, but in this scenario, it could also be a good thing, because this regulation can lead to tokenomics that is more honest and more sustainable designed, and also more transparent.
Wonderful. Thank you once again. Now, I saw already Tony and maybe even Jesse kind of like, you know, how do you say that? Nodding. Yes, or agreeing. Basically, Tony, do you have something to add here? Maybe even from your US perspective would be interesting too. And thank you once again, Zarina, for bringing this to our attention. Very important topic.
Yeah, I agree with everything Zarina said. The one thing I would say leading into 2026 is now we have more regulation, right? So before this, we had lack of regulation means only like the madmen are kind of in this state, right? Now we're all kind of circulating volume between ourselves. However, value is in the real world that didn't want to come in and take on legal risk because that was unknown, right? So for example, if you're a company that's doing $100 million in revenue, you don't want to put on a low cap shitcoin and try and see what happens, right? That's a huge risk. However, you don't even know if that might get your whole company sued into oblivion. So it would never get approved by the board. However, now because we have regulatory and compliance, now we can enable that value that previously was afraid to come into our world to come in. And they have regulatory ways to do. They have ways to do that through regulatory. Like, so when Zarina mentions like MiCA compliance as an example, they want to make sure that if you have a burn mechanic, that it's algorithmic and not just where you could just take tokens and burn them whenever. Why? Because of, hey, people are saying, hey, I'm going to burn 10% of the supply. They would do that as a pump and dump event, and then they would do that kind of stuff, right? So when you think about what's being enabled through the regulation, a lot of these things is really trying to be helpful for the industry, but sometimes MiCA can be very overboard in most cases, because I've seen, for example, 00 had their MiCA white paper on their website, and yet that thing got sold into the ground into oblivion right away. So in my standpoint, that clarity in regulatory still did zero, because the investors then got absolutely destroyed. So did that actually work? No, it's literally right now you can check the site, Google the white paper, look at it, and then look at the chart and ask if it worked. That's all you need to do. Right? And so anyway, we'll end it here.
Sold into oblivion. We should use it as a quote somewhere. Please go ahead, Zarina.
I just wanted to add really quickly, because I mean, I agree with Tony. It's now this shift is really coming on, that we have more regulation and more guidance, but it's at the same time it's still very unsure, because in Europe, for instance, we have the MiCA. MiCA is globally for Europe, but then we have each of the countries, each and every member state in Europe, they actually have to interpret and set their own rules how the company should live up to MiCA. So that makes the space and the field actually really uneven if you compare countries in Europe to each other. So it is still uncertain. We are for sure in the early ages of this regulation, but hopefully it can be a good thing also.
Most definitely, most definitely. before we kind of like close up, what I would love to ask to Tony and Zarina is to think for a second if over the last hour or so you forgot to say something really important that you really feel that is important for your audience to know. In the meantime, I would also love to move to Jesse for a second and ask if there is something that you feel like bringing up. Can it even be about Thrilled Labs? Although, of course, this event is not about us. Let me move to you, Jesse, as well, because I know you have a lot of knowledge to bring to the table too. And you're muted. I know you have sounds in the background.
I keep muting it. It's loud around here. Well, I just saw the last question pop up from Henny, so I actually wanted to address that real quick, if that's okay. Because I know of a few projects that are out there right now that are using tokenization currently for sustainable projects. There's quite a few out there that are doing things like gathering data of solar farms and things like that, and basically linking in to how well they're working, their performance rates, peak times, off-peak times, failures, all that kind of stuff, and tokenizing all of that data and basically being able to make that entire industry a lot stronger. And then, as far as, you're doing the same, they're doing the same thing with wind farms, they're doing the same thing with all kinds of things, tokenizing all of that data, things that we have not been able to gather and put together and use for the greater good. Those things are really coming together and being tokenized and being used as permanent data. There's also things being used for like farming and all kinds of stuff like that. How much rain is being dropped in a particular spot on your farm? How much sunlight is going to a particular spot on that farm? And then also being able to have those all of those data points for the buyers to be able to trust your product. Wineries are doing those kinds of things. There's a lot of stuff out there in kind of the environmental space just generally where the data is being tokenized for the greater good.
I apologize, but I do have a hard stop here at the hour mark. But I wanted to say, as I love everything he said, because I love all of that kind of stuff, even power purchase agreements, how you could fund some of that for, that's a whole nother thing altogether. But last thing I wanted to say is, you're nothing without your team. Wanted to highlight my team member Abdur, who helps a lot with a lot of our simulations and work behind the scenes as well. So he's a big part of what we're doing here. So I'm representing Tokenomics.net. He's a piece of that. And that's the last thing I want to say as I head off. And it's been great meeting with you all today. Thanks a lot for your time.
Thank you, Tony. Feel free to hop off. Then we'll move to Zarina. Thank you, Tony. Much appreciated. All right. Fantastic. Zarina, do you have any last words, perhaps, or even not last words, and we see you back at some other point? But yeah, anything you want to add, maybe, of all the different things that we've discussed, and then we're about to hop off after that as well.
No, but I think it has been a really great discussion, and I hope the audience as well, or the listeners, has gained some great knowledge, because this has been amazing. And also I can just, if a team or if a product should launch a token, I mean, usually they should be very aware of understanding user behavior, and because sometimes when I think we have seen that a lot, because many times a project uses token mainly as a fundraising tool, and that means they are launching the token too early, and that creates more problems than it solves usually. So that was just something we can briefly cover or raise.
Oh yes, absolutely, absolutely true. Thank you so much for saying yes to our invite, for joining the EstaSHE community. Once again, it was really a pleasure. I would love to thank Tony, who has already left, you, Jesse, as well, and you, Zarina, for joining this event. The next one will be in January. Very much looking forward to that one. And yeah, thank you, honestly, all of you, for being here and in the audience, or maybe you're watching this later. If you have any questions, or you need some expertise, reach out to our speakers. They're all lovely people who will reply super fast and kind on LinkedIn, or reach them on Thrilled. If they are on Thrilled, that's also perfectly fine. Thanks everyone for having joined. I'm Alex, founder and CEO of Thrilled Labs. With us as well, Jesse, the CTO of Thrilled Labs, founder of Decentralized Ventures as well, and of course, Zarina, tokenization strategist, and lots of different other things as well you're doing at Blockchain Sweden. So maybe that's another interesting thing to tap into. Look it up, everyone. Thank you all for having joined. I hope to see you next month. And be thrilled, be excited, and happy holidays as well, by the way. Almost forgetting that. So happy holidays, and up to a chilling and super thrilling 2026. Thanks, everyone. Bye-bye.
Thank you, Alexandra. Thank you for having us.
Bye-bye. All right.